Good day, students. Welcome. We're going to do study unit 3 is understanding financial statements. This is a very important topic, not only in financial management, but also in accounting itself. There's 3 statements we normally work with. There's many more, but there's 3 statements we normally work with. And this is the 3 statements that will be tested. Okay, meaning you need to know the theory and you need to know how to do the calculation. Okay, let me just. So, outcomes. At the end of the study unit, you should be able to understand the different types of financial statements. And when we talk about the different types, we're referring to the 3 different financial statements that we are going to work with. You must be able to prepare the statement of profit and loss. That's the old name was called an income statement. The statement of financial position, the old name was called a balance sheet, and the statement of changes in equity, that was just the equity statement. But what we've done, or if you can just incorporate the statement into the statement of financial position, which I will show you, that is also fine. So the different types of financial statements, this is not the only 3. There is more, but these are the 3 that we're going to work with. It's the statement of comprehensive income. This statement, you only use income and expenses, and this statement, you want to calculate if the company had made a profit or a loss. Now the loss is in a bracket just to indicate that it is a negative. The statement of changes in equity, this statement only deals with the owner's equity. Now basically, when we talk about owner's equity, we talk about the owner's money. Now, a word that I think you guys are very familiar with is the word called capital. Now, capital is basically the owner's money. If you want to start a business, you take out money to start the business. The money that you take out and you are the owner is called capital. And then you get another term, it's called drawings. Now drawings is everything that the owner takes out of the business, right? And then we have the statement of financial position. This statement, we only work with assets, liability, and equity. And for this statement, we want to make sure our assets, which is the money that we own, is equal to our owner's equity, which is the owner's money, plus the liabilities, the people that we owe. Remember, we did previously, we spoke about solvency. Now, solvency, when you are solvent, it means that your assets is more than your owner's equity and liabilities. When you are insolvent, actually another word is you are bankrupt, you are broke. It means that your assets is less than your owner's equity and your liabilities. So what you need to know for you to have better understanding and get good marks for this question, you must be able to identify in any question what is income. Now, income is all the money that you received for selling your stuff, your business. It's everything that flows into the business. You must be able to identify what is an expense. An expense is everything that you pay, the people that you owe. Then you need to know what is the owner's money. That is normally capital. Now, if your company makes a profit, that profit is also your money as the owner. If the company makes a loss, that's also your responsibility. And then we get the statement of financial position. You must be able to identify what's an asset, meaning assets are good. Assets are those things you can use to generate money. You can use to make money. Liabilities is not so good. Liabilities is all the people that you owe, right? And then you get equity. Equity is basically the owner's money. Now, there's a difference between a liability and an expense. And there's also a difference between an asset and an income. Both an asset and an income are good. Both an expense and a liability is bad. Why? Because you owe people money. But the difference between the two is an income, it can only be an income for 1 year. Expense exactly the same. But a liability and an equity, you can have it for longer than 1 year. Let me explain. An income, if you sell something in this year, will you be fine to only get payment next year? Then at the end of the day, you will not be making any profit for your business. So meaning an income is something that is only valid for the year. So if I sell something this year, I want the money this year. And so is an expense. Let's take another example. If you have insurance, right? The insurance company will not cover you and tell you you can only pay me next year. Or a municipality, they won't give you benefits. Okay, we still don't get the benefits, but in any case, if they give you the service, they want the money in the same month, right? Now, a liability and an asset is, an asset, if you buy a car, right? This is a car. This is how my car looks. Right? You buy a car. This car is an asset. Why? Because it belongs to you. But the amount, how did you pay for this car? You made a loan at the bank. Now this loan is a liability because you need to still pay the bank its money, right? Now this part of it's good because it's yours. You can now do deliveries. You can now take it and go and market your business at another place. So the asset part of it is good. But the money that you owe, the liability is not so good. Because remember, if you don't pay, the bank can now come and take the asset. So let me just recap. An income and an asset, they're very good. But there's a difference. An asset, you can pay over this car over 5 years. You don't have to pay it in the same year. But an income, you need to receive the money in the same year. And a liability and expense, though both of them is bad because you need to pay someone. You owe someone money. But an expense, you need to pay it in the year or on a month-to-month basis. And a liability, you can pay over this car over 5 years. Right. So if I ask you a question, let's say, what is the difference between a liability and expense? It's the time. So you're not going to write it's the time. You'll say an expense needs to be paid within the year. A liability can be paid longer than a year. If I can ask you the difference between income and an asset, the same thing. An income needs to be received within the year, and an asset needs to only be, or you can use it for longer than 5 years. You basically get the benefit for longer than 5 years. Now this is called a statement of comprehensive income. But we don't only get one type of business. Remember when we started, we spoke about the management accountant. A management accountant, you'll normally find him in a manufacturing business. Now a manufacturing business has the framework looks different of a statement of comprehensive income. A manufacturing business, they have sales, right? That's your cash and your credit sales. Now, what is a credit sale? A credit sale is something that you did, but you haven't received cash yet. Let me explain. A cash sale is, let's say you make handbags and you sell it as well. Now, a cash sale is when I give you the handbag and you give me money. right? Or you give me the handbag and I give you money. That's a cash sale. Nobody owes no one nothing. A credit sale is when you give me the handbag, but you don't get your money immediately. It means that you gave me the handbag on credit. That's called a credit sale. Now, there's cost of goods sold. You get the direct cost, labor cost, material. This is basically cost that you incur to make the handbag. Then you get gross profit. Then you get operational expenses. Those are your indirect costs. So let's say you are making the handbags. The direct labor will be the people that know how to make handbags. The material will be whatever material you're using. Are you using leather? Are you using plastic? Are you using whatever material you are using to make the handbag? The indirect costs, those is the marketing, right? This person indirectly the person doesn't make the handbag, but he helps to sell the handbag, right? Marketing, your admin, those are all indirect costs. Then you get your operational income, investment income. Now, what you need to know here is, this we can ask you as a theory question. We normally don't test the manufacturing because there's very few manufacturing companies. There's more your sole proprietor or the retail. Now, that's what we normally test. Right? So what is it that you need to know here? You need to know the framework. So we can ask you, right? For example, name an operational expense. Then you need to be able to tell us what's the operational expense. And see here, as soon as you see the word etc., you need to go to your textbook and see what else is there. Because we are not limited to the slides. When we set up the test, we set up tests based on slides and the textbook. So don't only work through the slides. As I've said in the beginning, the slides is only a skeleton. You need to put meat on it. And we can test the whole body, meaning we can test the skeleton, which is the slides, and we test what's in the textbook, which is the meat. So this is basically a more theory question. We can ask it in theory. Then we have the statement of comprehensive income. This is the retail. This is the statement that we use most of the time. Now we get sales. Now guys, please go and study this. This is the framework, right? Go and do yourself a favor and study it. Because once you know the framework will lead you in the answer, because this is how your answer needs to look. Right. So now, we have sales. Sales is stuff that you sell. Then we have cost of sales. Now, cost of sales, there's two types. Right? You get the perpetual one and you get the periodic one. Now, the periodic one is the one that we're going to ask you to calculate. Or the perpetual is the one that's given. So basically, when you get a question, the first thing you need to go and see, did they give me the cost of sales amount? If we gave you the cost of sales amount in the question, don't go and calculate it. If we didn't give you the cost of sales, we will then give you this. These are the elements to calculate the cost of sales. So if you don't, first things first, you go and see, did we give you, did we give you, this is part of it. You go and see, did we give you cost of sales? If we gave you cost of sales, you don't calculate this. If we didn't give you cost of sales, we will give you these elements. Then you must be able to calculate the cost of sales. Guys, know this. Know how to calculate cost of sales. It's always opening inventory plus purchases. Now you need to remember, carriage on purchases is just another word for transport. Okay, now if you buy something, let's say what you are buying cost you 2,000 Rand, right? You're living in the Vaal, but you are buying it from someone that's in Pretoria. For you to get it from Pretoria to here, who is responsible for it? You are. The buyer is, not the seller. So meaning your carriage on purchases makes your purchase price more. So you then have to add carriage on purchases. Then your purchase returns, let's say you bought for 2,000, right? But you're not happy when you receive the goods and they tell you there is a return policy. You send back goods worth 500, meaning you started off with 2,000, that's what you owed the people you bought it from. Then you must send back 500. It means at the end you can't owe them 2,000 anymore. You must owe them 1,500. Why? Because you deducted the 500 because you sent it back. And that's called a purchase return. There's the carriage on purchases. Remember I explained it. It is transport. You must add it. And then you must less your closing inventory. Then sales, less cost of sales. So we're going to let's call sales 1. Cost of sales 2 will equal to your gross profit, which is number 3. Then you're going to add other income. Now other income is income that you get, but it's got nothing to do with your business. So if you are selling handbags, right? Getting commission has got nothing to do with handbags. Let's say you're getting commission on a property, right? Property and selling handbags is 2 different things, but it's still an income. So you need to add it there, but you add it either under other income and interest that you receive, right? Interest that flows into your business, it's also an income for you. And then you're going to say, let's call this number 4. So number 3 plus number 4 equals to number 5. Number 1 minus number 2 equals to number 3. Then you get your less your expenses. Now expenses is all those things that you need to pay to get your business or to keep your business running, right? For example, you need to pay salaries. If you don't know or you're not selling the handbags yourself, you've got salespeople. You need to pay them salaries or wages. You need to pay for your telephone, your electricity. These are all expenses that you normally have when you run your business. But I want you to notice this one. Carriage on sales. Carriage on sales is transport on sales. If you agree with the purchaser and you say, I will come and drop it off at your house, it is an expense for you if you agree. If there's no agreement, the purchaser must pay for it, right? Then you get EBIT. Now, EBIT means earnings before interest and tax, right? And then, let me just make this smaller, just to show you. Now, can you see earnings before interest and tax? Then you less your interest. Then you get your earnings before tax. Then you less your tax. And then you get your EAT, earnings after tax. So we can basically ask you, calculate it. Then you need to know, you need to do all this to be able to get to this part, which is your EAT. Okay, that's your statement of comprehensive income. Then we get your statement of changes in equity. Now remember I told you there's a statement that you can incorporate into the statement of financial position. This is it. I'm going to show you how. Now this is equity, meaning it's the owner's money. Now how do we calculate this? Go and study this. Because even if you're going to incorporate it into the statement of financial position, you must still know this. Capital is the money that the owner took out to start the business. Additional capital contribution. Now this is after the date. Let's say he started his business on the 20th of February, 2022. Then he takes out money on the 1st of January 2023. Or, let me rather do it like this. Let's say you start your business, everything is registered. Then you take out more money on the 21st of February 2022. This is called additional capital contribution. Right? The money you initially took when you started the business is called capital. Everything you take out the day after, like if you are the owner, it's called additional capital contribution. Then we get retained earnings. Now, retained earnings is just another word for profits. But the difference is, this retained earnings is last year's profits. When we call it profits, it is current year. Current year. When we call it retained earnings, it is prior year. So let's say, for example, they tell you, I'm just going to write here, you made a profit of 10,000 in 2021, right? Let's say we are in 2021 year. In 2022, they'll tell you, you made profits of 5,000. Now, this profit that you made in 2021, you will also account for it, but you will not call it profit, you will call it retained earnings. Let me give you another example. Let's say we get into 2023. So 2023, they say you made more profits, but this year, this 2023, your profits is 15,000. The 15,000 is profits, and let's say you didn't use the 10,000 here, right? You didn't use the 10,000. So in 2023, you're going to take this retained earnings, which is the 10,000 that came from 2021, plus the profits of 2022. That name will also be called retained earnings because it was in the previous year. Then you get your profit or loss, that's the current year. Then you get your drawings. It's whatever the owner takes out of the business. So if you are selling handbags and you take a handbag, it is called drawings. If you are selling handbags and you take cash, it is still called drawings, right? And then this will give you your shareholders' equity. This you take to the statement of financial position. Now I want you to see this, right? That part that I told you is actually this part. So you basically just take the statement and you add it here. Now what this statement of financial position is, it says your assets must be equal to your owner's equity and your liability. If this balances, then your statement is fine. Now I just want to do it, that was just to show you the balancing, but this is the statement. This is the framework of the statement. Guys, please, ladies and gentlemen, go and study this framework. As I said with the statement of comprehensive income, you are going to make this thing so easy for yourself if you go and study the framework. So this is it always, and this is how it always looks. It always starts with non-current assets. Then you must know what a non-current asset is. Then it's current assets. Then you must know what current assets is. Then this, the non-current plus current equals to your total assets. Then you must get equity and liabilities, meaning this total assets must now equal to your total equity and liability. Now this is the part, total equity. Now you see this answer number 1 is actually the answer that you get here. Okay, so you're basically just going to take it over, or you can do that statement here. Shareholders' equity, it says there, see the changes in equity statement. Now you take your equity plus your non-current liabilities plus your current liabilities, meaning you need to know that will give you your total equity and liability. And when this statement balances, you are 100%. But I just need to tell you guys, if the statement doesn't balance, don't cook the books. Don't make it balance. Because we basically give you answers to see, do you know what a current asset is? So then you get answers for all these elements. That's on the question that you can now bring onto the answer sheet. And we will see, okay, the student knows what a current asset is. The student knows what is equity. The student knows what is a mortgage bond, long-term loan, bank overdraft. But now you will go and change these amounts here so that you can balance here. And normally we give you half a mark for these two answers. So don't cook the books. If these two amounts don't balance, right? Yes, it's not nice, but it's not a train smash. It is worse if this balances and these amounts are wrong, because then you're going to get most of your stuff wrong. Thank you, students. See you next time. Bye.